Marty Missouri here. It is Friday, the 12th of December, 2025, with a super quick market commentary for you. Our time right now, mine especially, is very occupied by working through the core portfolio strategy heading into next year, making adjustments, sector weightings, regional weightings, overall asset class weightings, then testing them against different scenarios, different macro regimes, if you will, heading into next year, thinking a lot about the setup, been writing about the setup and so on. So today I'm just going to look at one chart, and it's the weekly S&P 500 chart, and then talk about two news headlines that I think are explaining why the S&P 500 on the morning is down over 1%, 1.15, which is a pretty good drop. The NASDAQ 100 index is down over 2% as I speak. Tech stocks are down nearly 3%, the group itself. Only things that we see in the green, at least in our core portfolio this morning, are AT&T, Platinum, Technip, which is an energy company out of Europe, Delcath, which is a biotech company, Deckers, consumer staples stocks, which we added to, and healthcare, which we've added to. Gold is up a little bit, and REITs are up a little bit. Everything else is down, and some things are down a bunch. Our portfolio, our core, is down 0.64% as I speak, so not as much as the 1+% for the S&P or the 2% for the NASDAQ, but again, we're not anything like an all-stock portfolio. We've got lots of correlations that oppose one another, which is what you do in a very diversified portfolio, which is what you need right now. We're going to continue that spirit into next year, but we are definitely tweaking some of our allocations. And there's more of that to come. You got part one of our year-end letter here a couple of days ago. Part two will be coming sometime over the next few days. So that chart that you have in front of you, we'll start with that, is the S&P 500 weekly chart. I haven't been looking much with you at the long-term chart, so we're just going to skip the daily chart. It looks the same as it's been looking. But the weekly chart may be telling in terms of the near-term setup. Remember, the beauty of the long-term charts is that they're easier to look at. There's a lot less noise. And frankly, I think the types of technical indicators that we respect the most become more valid. It's just, the timing, they're just slower moving. So just to kind of set you up for what we're looking at right here, you can see that back here in 2018, as we were moving through this rising wedge pattern, the momentum on the moving average convergence, divergence, and the relative strength coming off of notably overbought levels was rolling over, and we ended up with a 20% decline in the fourth quarter, and there we were, off to the races again. Had a bearish divergence right before the COVID debacle, but then right here before the 2022 30% decline, we had very notable rising wedge pattern for the most part, but real notable divergence coming off of overbought levels. And it works in the other direction as well, as you may recall, and we made some moves that paid off right in here, and that is that we had a declining wedge pattern, which is bullish when you have bullish divergences on the indicators. So these signals pretty much without fail the last 5 years or so anticipated sell-offs, 11%, again, nearly 30%, call it 10% right here. This was about 21% earlier this year, right? And look at what we have right now. Rising wedge pattern, new all-time highs right there, really rolling over, sell signal here on momentum, and rolling over here on the RSI off of overbought levels. So folks, I still think you can hold out hope for the Santa Claus rally to finish the year, but this is telling us to expect that there's probably some corrective action coming. So two headlines that top the Bloomberg headlines here, as you can see. are Oracle delays some data center projects for OpenAI to 2028, and the NASDAQ 100 drops 2% as 30-year yields drop. So as for Oracle, the stock has been getting utterly hammered since earnings earlier this week that said revenue came in just a little bit light. It was still massive, but it was a little bit light. But they spent 50% more on CapEx in these data centers in the third quarter than they said they would earlier. They spent $12 billion instead of the $8 billion that was forecast. Now, if you recall, 2 or 3 weeks ago, I did a presentation here where I showed you that companies that engage in super high capital expenditure tend to underperform those in their space that didn't. So over the next 12 months, across all sectors, there's a notable underperformance, or there has been historically, for the companies that are spending lots of money right now. Notwithstanding the potential long-term impact of that spending, in the near term, it is spending, right? And it's going to show up next year in cash flow and the ratios and things that Wall Street is thinking about. And they're anticipating that the numbers are not going to be good, and therefore the stocks begin to contract. The fact that Oracle is delaying data center projects, it looks like it may be somewhat of a response to that. The concern is, how are they going to make money enough to justify all this spending? And that's the big question on Wall Street. We've been asking that question for quite some time, but now it's being asked every day, and it's having an impact on stock prices. NVIDIA is down notably this morning as well. But what Oracle says is that they're delaying it because of material constraints and capacity constraints and the ability to actually get it done in 2027. So we'll see how that plays out. As for the NASDAQ dropping 2%, the summary of the article, falling as much as 2.1%. Tech shares are getting absolutely hammered. The yields rose 5 basis points to a 3-month high after Cleveland Fed President Beth Hammack said she would prefer interest rates to be slightly more restrictive to keep putting pressure on inflation. So this is what I struggle with, folks, and I've illustrated for you many times in the past as to why. Here we have the long-term Treasury bonds selling off noticeably. Our long-term Treasury ETF is down almost 1%. That's a big move today. The dollar up a little bit on the higher yields, up 0.16%. So I would argue almost the opposite, that if Ms. Hammack came out and said, I'm uber dovish and I'm going to vote for aggressive rate cuts, that would justify a jump in long-term yields and a drop in bond prices like the one I just talked about. Because that would be pouring more juice into an economy that's about to get a lot of fiscal spending juice, and it's got embedded inflation, or I would say cumulative inflation, that is making life very difficult for the bottom rung of the K-shaped economy we keep talking about. These are the folks who are doing well on their income and own assets and are feeling rich. These are the people who are having a tough time affording the accumulated inflation that we've had over all these years, let alone further price increases. So if the Fed were to become more restrictive and keep money more expensive, keep monetary policy tighter, that would be a drag on the economy, right? And if it ultimately works, it would be a drag on inflation, and therefore long-term bond rates should go down, not up. So I'm not sure this is the right narrative, to be honest with you. I'm not sure that the author of this article really gets what's going on under the surface with yields today. But so I'm thinking maybe it's something else, but we'll see. And we could speculate as to what that is, but maybe we'll do that next time. Okay, so let me just for a minute, those of you who haven't read the year-end letter yet, clients, I highly suggest that you do. So I think that we need to be very, very cognizant of the fact that this stock market is so inflated and so levered and so important to the upper line of that K, right? That if the market were to come crashing down, I think it would be a replay of the tech bubble bursting, where we had a recession that was brought on by a stock market crashing, not a stock market crashing brought on by an economic recession like the 2008 scenario. And like you'd normally think, these things should play out. So here's just a snippet from part one of our year-end letter. Again, inflation be damned. The massive incentive to do whatever is politically possible to keep this stock market bubble afloat has us thinking that equities have yet more runway ahead of them, notwithstanding the heavy dose of volatility we'll certainly have to endure in the months to come. And of course, we are notably enduring that as I speak at you this morning. So from an earlier blog post, we're reliving that dot-com setup. As I just said, bear market stocks would catalyze an economic recession. Political motivation to keep the market afloat is huge right here. Thus, I anticipate tariff relief over the coming months, friendlier geopolitical rhetoric, and so forth. Then there's the Fed. The market at the time I wrote this was having a rough go of it. That was at 4%, hit, I think, in October. And the odds of a December rate cut were getting cut, and stocks are falling because the market thinks it needs that juice. Should equities continue to sell off, the Fed will no doubt grow very concerned about the risk that they'll cause or be blamed for, and that dynamic will bring on the next recession. All else equal, they'll be cutting rates. Ironically, on the day I wrote that, this is back to the year-end letter, futures were pricing in a 20% chance of a December rate cut. Then while I was writing this note, it had improved to 97%. This was earlier this month when I was working on this. And then we got the rate cut, and we got a huge two-day rally in everything except technology because of the Oracle news. So, folks, to what degree is this an investable thesis? Certainly not to the degree where you think that the powers that be have the markets back, therefore you should load up the truck and just go crazy and keep investing in stocks. Unequivocally, that is not how you're going to make money, I think, or do well going forward. I think that we have to respect essentially what I said earlier in the letter. I talked about a meeting that we had, and we have meetings every morning, where I showed the fact that tech is at record levels in terms of sector weightings in the S&P 500. Then I talked about the history and my own experience of that when the business cycle gets long in the tooth or grows long whiskers, as I say here, a single sector dominates the major averages weighting, or when it does, you can place a certain bet that that's the cluster of stocks that will not do well, relatively speaking, going forward. That seems to be how it always plays out. So we're not looking for tech to be the place to be during the next cycle, or maybe even the next year. In fact, I will be very surprised if we end next year with tech being the top sector once again. Larry McDonald, in a very good book, if you like this sort of thing, I highly recommend it. He wrote it. It was published last year, How to Listen When Markets Speak, Risks, Myths, and Investment Opportunities in a Radically Reshaped Economy. So he basically just points out what I just pointed out. So folks, this is going to be a challenging market going into next year. Listening this morning to BCA's top analysts, they think that a recession is coming this next year. I'm open to that idea. Our own index is flashing uncomfortable recession risk. I will say that when the government's spending 6% of GDP, or running a deficit, I should say, of 6% of GDP, probably going to be tough to have a recession unless you have a major stock market sell-off. Therein, you get the support that they may not succeed at in terms of keeping it from happening, but my oh my, are they going to move heaven and earth to try to keep the stock market from crashing next year would be my best guess. Again, still big risk. So you want to diversify. You want to probably underweight U.S. stocks going into next year. And again, I'll talk about how we plan on doing that and take advantage of where there are opportunities, and frankly, try to take advantage of where they're going to be spending all that money this next year into the economy. So folks, I'm just going to do a hard stop right there. I said it would be quick, a little longer than I expected, but I appreciate you hanging in there. Hope you all have a wonderful weekend, and I'll talk to you again soon. Take care. Bye-bye.